Okay, as you may have noticed, I've spent a bit of time on market structure, and this has been deliberate because I believe that it is the foundation that you need. It is the foundational topic that you need for you to be successful in Forex. So specifically, I have gone to share a lot about support and resistance. Okay? And I have shown you how, or first, what support and resistance is, and then the concept of price cycle as regards support and resistance. And then I did not touch very much the major patterns, which I will today. Okay? And then today we shall look at what are the time frames and how they're related to each other. And then finally, we shall look at fractal nature of time. All right. Oh, and then of course we look at the forex, the forex major markets, the times. All right. So on support and resistance, and I know I keep going through it back and forth, but the reason why I do that is just to re-emphasize the importance of support and resistance. So, but today I'll just run through it very quickly. So when the market is moving up and down, we can draw support lines, support and resistance. Okay, so you'll find the market will go something like that, and then it will go up, then up, and then up, and then down, down. Okay, sometimes lower, and then it starts its journey again, up, and so on. So because the market doesn't move on a straight line, if you look at the details of this, you'll find that there is some kind of places where the market seems to be turning a lot. Okay? So you need to know how to draw your support and resistance lines. And we said that support is the bottom, okay, part where the market seems to be turning around. So in this case here, we could agree that the support line is something like this here. Okay. Okay, and the resistance, when it goes up, it hits a roof somewhere, and we can pretend that that is a roof. Okay. Why? Because it seems like when the market reaches there, it respects it, it comes down. When it reaches down here, okay, it respects the bottom, it comes up. So the line on top, which doesn't come with your chart, is what we call the resistance. Okay? And the line at the bottom is what we call the support. Okay. As we dig down deeper into the market itself, you'll find that the market seems to respect many such lines. So you find that maybe around here, okay, that the market also respects that line. Okay, if you go here, you'll find that the market also respects that line. Okay, as you go down, every place where the market turned or paused or something is a point we call a significant point in Forex. And the market always respects significant points. Hence, when it gets there, it pauses a little bit and then it goes. Okay. Or if it is just passing, then you'll see there will be something significant happening. So for us as traders, and the kind of trader I'm trying to teach you to be, which is price action, or sometimes people call it naked Forex. I'm trying to help you understand the market structure to a point where you don't need indicators. There are things they call indicators. Indicators are like cheat sheets, but those cheat sheets are formed based on these candlesticks. In other words, they are what we call lagging indicators. They are not things that happen in real time. They're things that happen after the market has moved. So to me, it's a waste of time teaching you things that the market has moved. However, in your own reading, in your own understanding at some point, if you want to know about them, fine. In the book I shared, the guy, Mario, talks about the indicators and how to use them. That is fine. For this particular class, this is our modus operandi, just, getting to know the market as is, naked as is, because then we can effectively trade. All right. So then what did I talk about? I talked about, so when we go to the real charts, I'll show you what price and support resistance is. And then I also mentioned what a price cycle is. And we say the price cycle really is just the movement of the market from one low. Somebody was coming in. So, all right. So the market, okay, I get distracted when I have to allow people to come in. Okay. So the price cycle is the movement of the market from a particular low to a particular high. That is what we call the price cycle. And you may have seen that before, but I'll just give you an example here. So here we can say that the market is moving basically from this high, okay, at point A, and this is point B. Okay. So the price cycle is when the market moves from a high to a low. Okay, we consider that the price cycle, and especially if it does it more than once. Okay. Somebody has their volume on. Uh, can you guys mute? Okay, I'll mute the microphone. Okay, all right. So the last high to the price, to the next low, the distance from there, from A to B, is what we call the price cycle. Okay, and of course, you'll probably ask me, so what about a small distance, like let's say from here to there? Why is that not a price cycle? It's not a price cycle because this market has probably moved between these two support and resistance, A and B, for a while, at least for, if there are 3.1, 2, and 3. Okay. If you see the market moving, maybe between point A, point B, point C, and it has established that from A to C is like a straight line, and then there's a point B, okay, it means that you have established the highs and the low in the sense that it's more like either triangle or I think they call them, okay, the fact that we have something like that. Any three of these will be a confirmation of, you can call it a channel, you can call it what, but these two parallel lines, okay, so line X on top, sorry, wow, X, okay, and then line Y. So these two horizontal lines, okay, if the market touches the horizontal line at minimum twice at the top. So 1, 2, and 1 time at the bottom, that should be enough to give you an idea that this could be the price cycle, the distance from X to Y should be the price cycle. By the time you're getting that fourth touch over there, then it's not just letting you know what the price cycle, but it's also telling you that actually these two lines could be parallel. Could be parallel. That means the market is moving between this particular resistance point and that support point. Okay, so that distance from either of them, either from here to there or there to there, is what we call a price cycle. Why is that important? It is important because it helps you decide when you should take your trades. And many of you in the homework 1 and homework 2, you found that you are taking trades that are not taking profit. The reason is you probably entered the trade, either too early or too late. So what do I mean? What I mean is, if this is a price cycle, okay, you do not want to enter trades like a buy. So if you hypothetically draw like a midpoint, okay, so let's call this the midpoint of the price cycle. We are at midpoint. So anytime you cross the midpoint and the market is coming from down and going up, you know that chances are it will continue up. Okay. When the market comes from up going down and it crosses that midpoint, chances are it's going down. All right. So if the market is below the midpoint, more near the support zone, you don't want to sell. Selling means you're going down. You never want to sell at the bottom. Okay. And that is common sense. You don't sell things when the market is low. You wait for the market to go up. So you never sell when the market is down there. So anywhere below, from here to halfway, you avoid selling the market. Why? If you sell the market, chances are you will you will enter into a loss, because the market might have reached the bottom and now it's on its way up. So what you want to do when the market is down here is you want to buy. Okay? So you have to determine where is the price at that point in time, if it's at the bottom or at the top or somewhere in between. But first, let me give you cardinal rules. When the market is at the bottom, you want to buy the market. Buying means you are entering long. Called another word they use. They say that I'm going long on the market. Okay. Another word they use also apart from long is bullish. So if somebody says the market is very bullish today, well, this is what they mean. They mean that the market is going up and up and up and up. Okay. So bullish. The market is like a bull. The bull has a horn, so and the horn faces upward. So when you buy at the bottom, you say we are bullish or long, or we just buying. All right. When the market is past halfway, and now it's almost nearing the top, okay, almost nearing the resistance. Now look for opportunities to sell, because the market will turn and will go down. So what does it mean to sell? Well, to sell when the market is up there, it means you are shorting the market. Okay, literally the word short. So you are shorting the market, S-H-O-R-T. That's what you say. Another word you use is you are bearish, like a bear. So in business language, or if you open CNN or Bloomberg or something, you'll hear them say, oh, today the market has been bearish, or since Trump lost the election, the market has been seemingly bearish, meaning it has been going down and down and down and down. Okay. Or when during uncertain times in America, the market was very bullish. Okay, bullish means it was going up and up and up. Okay? Bearish means going down. So when you look at a price cycle, when the price has reached the top, it has lost all the energy. Now it wants to turn around. You look for opportunities to sell. Now, I am re-emphasizing that a lot to let you know that that's where sometimes you find you take trades and they don't take profit for a while. Why? Because at here at the top, when the market was turning and starting to go down, instead of you selling, you entered buy trades. And that's how people lose money. When you buy, when the market is going down, you are going against the market. So the market is not going up, but you're busy buying. The market is going down. So back to your homeworks. Before you take your buy or your sell, try and establish the direction of the market. Try and establish where are you in a given price cycle, in the 1 minute price cycle. Where are you? Are you near support zone, means at the bottom, or are you near resistance zone, meaning you are at the top? If you are at the top, you wait for the best entry, which in that case will be once the market turns, then you sell. If you are at the bottom, you wait for the best entry for the opportunity to buy, and then you buy. All right. That way, the market will not go against you. That way, if you look at your 1 minute, 5 minute, 30-minute homework, chances are your trades will be taking profit. They will be consistent, and you will be making pips. Okay. So going forward, we shall work on accumulating those pips, so that if we want to make 10 pips, okay, in the market, well, I can make 10 pips by maybe taking 5 trades of sell from here. If the market is here and it's going down, and I want to make 10 pips, well, 10 can be looked at. 10 is equal to 5 times 2. So I could either take two trades of 5 pips each, and that'll give me 10, or I take 5 trades of 2 pips each, and that would give me 10. So it doesn't matter which one I do. If I want 20 pips, the same thing. I can take 5 times 4, 10 times 2, 10, and so on. So there are many ways to achieve the number of pips that you want in the market. But from today onwards, I'm going to start pushing you for a number of pips. If I say today in our trading, I want you to do cumulative 20 pips. Show me you have done a total sum of 20 pips. Now, that is not the same as 20 trades. It is 20 sum total of pips. I want 20. You figure out how to get it, whether you're going to do 10 times 2, 5 times 4, and so on and so on and so on. As long as you give me 20 pips, okay? And that will be part of your homework. I will repeat that in writing. All right, so we're done with support resistance, price cycle, major patterns. Now, major patterns is just a small cheat sheet I will give you that tells you what are some of the popular major patterns, which means that the market doesn't do anything new. It always repeats the same thing it has done before. What am I saying? I'm saying if the market, like, you see, okay, if the market has this up and down thing, it will always do the same thing whenever it finds itself in a similar situation. This all at once. Okay. So the major patterns, I will send you a cheat sheet, which now you can use. It will tell you that when the market is moving this way, something like that, okay, and then if you draw a line there and a line here, okay, because it's moving like in a wedge, when it reaches here, it will have to either break up or down, depending on what's happening. It might break down. So this pattern here is a very common pattern. Okay? It's more like a wedge. It could be what we call a continuous pattern, which means that the market comes down, okay, it was going like this, okay, and then it forms. If you draw a line this way and a line there, you find that it's forming a certain shape, okay, and then it breaks out. So it forms something like a wedge, okay. So this pattern here is a common pattern. Another common pattern around London opening uh, is what we see called a breakout, a typical breakout, where if you draw a rectangle, okay, where the market has gone up and down between certain points, between up there and up there, several times, and then eventually it breaks out from there. Okay, so this is again another common pattern. When you see this kind of patterns, okay, that is one, another one. Then there could be another reversal pattern. There could be very many. So this is just one. This is another one. Is another one, and so on. Now, do I expect you to remember them all? No. But there's some common ones that once you start seeing them several times, once you have an idea, they will come in very handy. They will come to help you later in your trading. So I will share with you a cheat sheet on major patterns. And the patterns only tell you what to expect in the market, especially if you are between support and resistance. Now, the second last thing we are discussing today is time frames and the fractal nature of time. We have talked about this several times before, but not the level I want to share with you now. The time frame, essentially, the markets have been divided to allow you to monitor time, either from daily, monthly, weekly, uh, hours, minutes. Okay, so the lowest time frame usually is the 1 minute. 1 minute. Then the highest time frame is monthly. So as far as you're concerned as a trader, what that means, it means that the market candles, when they form, when the candles form, they take time to form. Sometimes it takes just 1 minute to form a candle. Okay. Sometimes that candle takes what, 1 minute, 15 minutes, 30 minutes, and so on and so on. So when you see candles in the chart in the market, that is the time frame. So why are they important? They're important in the sense that there's what we call the fractal nature of time, which basically means that what happens in a bigger time frame is essentially the same thing that happens in a smaller time frame. So if the bigger time frame seems to be going up, sorry, I'm trying to draw some candles. No? So if this big time frame seems to be going up, well, then if you look at a smaller time frame, The small time frame will have many instances of that. So we'll have a little thing here and a little one there, a little one there. Okay, 3 times. Then sorry, my drawing is not very good. So let's pretend those are candles. So you'll find that if this was maybe uh, 5 minutes, 15-minute time frame. And so in the 15 minutes, you have 3 candles, 1, 2, 3. If you look at the 5-minute candles, the 5-minute candles will have about the same instances of the 15 minutes. Okay, about 3 times, because 15 is 3 times 5. So if you look at the 15-minute time frame, you'll see something like this. But if you look at the 5-minute time frame, okay, we will see something like this. So it will appear 3 times. Why? Because 5 times 3 equals 15. So whatever happens in a bigger time frame can be looked at, duplicated in the smaller time frame several times, depending on what time frame you're looking. So if it's 1 hour, if something happens in 1 hour, well, in the 5 minutes, it'll probably appear like around 12 times. Okay. In the 30 minutes, it will appear twice. All right. In the 1 minute, it will appear 90 times. Oh, 60, sorry. That's 1 hour. So that's the fractal nature of time. Why is that important? That's important because what it does, it allows you to look at the bigger time frame to plan what will happen on the smaller time frame. You use the bigger time frame to plan what is happening. So in the bigger time frame here, I see these 3 candles and they are a buy. It means the 5 minutes, I expect to see buying for a while. Okay, for 555. Okay, that's the idea of the fractal nature. That is a very powerful concept, and we shall use it over and over and over again. That's why in trading, for us in our strategy, we use 2 time frames. So we use a larger time frame to give us an indication of where the market is going in the smaller time frame. So from a very, very high level view, it's like somebody flying. If you're flying from here to Mombasa, it means you're flying, for lack of a better word, let's say southeast, all right? So whereas the flight path is a straight line, where this is Nairobi, and this is Mombasa, well, technically, it is not a straight line. It is a lot of up and down to Machakos, then up, then I don't know where, and then up, and then down, and then up, and then down, and then up, until finally you reach Mombasa by road. But from the air, it looks like just a straight shot. So knowing that you're going to Mombasa, even when you're going to Machakos, you don't really worry when the road meanders around, because generally, even if it goes like you're coming back to Nairobi, eventually it will go down. If it turns around, I don't know, Mali, it's still going down. When it veers off to around Voi, it's not going straight south. It's just going down. So that concept of fractal nature is very powerful. So take time to read it more and learn it. Finally, today we are finally introducing you to the three major markets. We have the Asian market, the main ones, London and New York. It doesn't mean that they stop. No, we just put together the whole idea of the Asian countries, the fact that they're geographically in one spot, it means that they they tend to operate about the same time. Why? Because of the different time zones. The Asians are the Tokyo in Japan, the Hong Kong, um, Sydney, Australia, all these Asian tigers, Asian countries from Australia, because of the time frame. Right now it's morning here. There it is late afternoon. So the market has been busy. Their banks are watching. All right. So there's Asian market. We need to know what time they operate. But as far as Kenya is concerned, they operate from around 11 p.m. to around 7 or 8 in the morning. So these markets are about to close now. Okay. What about the London and European markets? In Kenya time, they open from around 8 till about 5 p.m. Okay, their time. All right. But in Kenya, we know that it's from 8 to around maybe 5 or 6 p.m. because they are a few hours behind us. Actually, technically, um, in Kenyan time, East African time, the London market opens around 10 a.m. and then goes on for about 8 hours till about maybe 5 or 6 p.m. Then the New York market opens up around 4 or 5 p.m. Kenyan time and goes on till about 11 p.m. So as you can see, that's why we say the Forex is a 24-hour economy. Why? Because from 11 p.m., then the Asian market is busy till about 8. Then the London market, then the New York market, and so on. So you can trade any of them, any of them. What is the significance of the markets? It means around those times, there's a lot of volatility for the currencies associated with Asia, like the Asian currencies, like Japanese yen, Chinese renminbi, London, the GBP, euro, Swiss francs, okay, New York, USD, Canadian dollar, all those currencies tend to be very busy around the same time, right? But more importantly, the currency pairs that have both, around that time become very, very busy. So essentially, we're done for the day. That is what I want to talk about. Today was just theory, nothing serious, nothing practical, but you have to go back and do your practice, do your homework. Again, for many of you are still struggling with the homework. Very, very basic, fundamental thing. Okay. So I will not go through the homework today, but I've mentioned to you that yes, it's possible to have a clean buy of 2 pips or a clean sell of 5 pips. It is possible. All right. Our time is almost up. We have about 2 minutes. If you have any question at this point, you can either ask it, but you will be cut off. But I propose that maybe if people are interested, I can have another session for just question and answers. But that will depend on the interest. I promised to be doing it in 30 minutes, and I think I've finished in 30 minutes. Today was an exceptional class, just an add-on to what I thought I need to finish these 3 things. So if somebody has a question or you guys have a question, I can open another session for us to have a Q&A, but only if you have questions. If you feel you can ask a question online, that's fine too. If you feel you want to call me directly, that's fine too. For those of you who have not done your homework, please do them because it's for your own good. I will not follow you up. It is for your own good. All right. Any question? Do you need more time? Okay. I don't hear anybody saying anything, so I'll assume everybody's happy, everybody's fine, and the class is ending in less than 1 minute. So do your homework, share the homework. Okay, that is the only way you'll know how you're doing. You will not know how you're performing until you do the homework. I'm available almost 24/7. Everybody who's asked a question, I have responded to your question. All right. So other than that, you have a good day, and we will talk on Monday. Do your homeworks. From Monday, we shall shift gears. Today, I will give you a homework on pips, number of pips. I want total pips now, not just the individuals. Okay, and you can know the number of pips you're getting by looking at your statement. All right. Have a good day. The
Good
class
day,
is done.
coach.
Thank you.